This is the first monetary policy statement of 2024, a momentous year for the Reserve Bank of India, which enters its 90th year of existence and operations on 1st April this year. Over the years, the Reserve Bank has established itself as a credible institution which stands for stability, trust, and economic progress. In recent years, it has become a pioneer in fostering innovation and technology in the financial system. Customer centricity and financial inclusion have always been its priorities. The Reserve Bank's tireless efforts towards maintaining a fine balance among price stability, financial stability, and external sector stability have paid rich dividends as the country embarks on a higher growth trajectory in the years to come. As India gains a pole position in the new global order, the contribution of the Reserve Bank is getting widely recognized both within and outside the country. The global economy continues to present a mixed picture. On the one hand, the odds of soft landing have increased, with inflation moving closer to the target and growth holding up better than expected in major advanced and emerging market economies. On the other hand, the ongoing wars and conflicts and the emergence of new flashpoints in different parts of the world, with disruptions in the Red Sea being the latest in the series, impart uncertainty to the global macroeconomic outlook. In this unsettled global environment, the Indian economy has performed remarkably well in the recent years. Growth is accelerating and outpacing most of the forecasts, while inflation is on a downward trajectory. At the current juncture, India's potential growth is propelled by structural drivers like improving physical infrastructure, development of world-class digital and payments technology, ease of doing business, enhanced labor force participation, and improved quality of fiscal spending. Our multi-pronged, proactive, and calibrated policies on the monetary, regulatory, and supervisory fronts have worked well to maintain and strengthen macroeconomic and financial stability. Let me now turn to the decisions and deliberations of the Monetary Policy Committee meeting, the Monetary Policy Committee, which met on 6th, 7th, and 8th of February, that is culminating today. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the Monetary Policy Committee, that is MPC, decided by a 5-to-1 majority to keep the policy rate unchanged at 6.5%. Consequently, the standing deposit facility rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. I shall now briefly set out the rationale for these decisions. The momentum in domestic economic activity continues to be strong. Headline inflation, after moderating to 4.9% in October, rose to 5.7% in December 2023. This was primarily due to food inflation, mostly vegetables. The softening in core inflation, that is CPI inflation excluding food and fuel, continued across both goods and services, reflecting the cumulative impact of monetary policy actions as well as the significant softening in commodity prices. The uncertainties in food prices, however, continue to impinge on the trajectory of headline inflation. Taking into account this growth inflation dynamics and the fact that transmission of the cumulative 250 basis points policy rate hike is still underway, the MPC decided to keep the policy repo rate unchanged at 6.5%. The MPC will carefully monitor any signs of generalization of food price pressures which can fritter away the gains in easing of core inflation. Monetary policy must continue to be actively disinflationary to align inflation to the target of 4% on a durable basis. The MPC will remain resolute in this commitment. The MPC also decided to remain focused on withdrawal of accommodation to ensure fuller transmission and anchoring of inflation expectations. I now propose to provide an assessment of growth and inflation. Let me take up first global growth. Global growth is expected to remain steady in 2024 with heterogeneity across regions. Though global trade momentum remains weak, it is exhibiting signs of recovery and is likely to grow faster in 2024. I would like to mention that I am making several statements, and the supporting data for all the statements that I am making, all the sentences that I am reading out, the supporting data is provided in the footnotes. So therefore, those of you who are interested can refer to the footnotes for the backup data in support of whatever statements I am making here. So let me just restart so that there is continuity. Global growth is expected to remain steady in 2024 with heterogeneity across regions. Though global trade momentum remains weak, it is exhibiting signs of recovery and is likely to grow faster in 2024. Inflation has softened considerably and is expected to moderate further in 2024. Financial markets are volatile as market participants adjust their expectations on the timing and pace of rate cuts by major central banks, who in any case remain cautious against premature easing in their fight against inflation. Amidst the current headwinds, elevated level of public debt is raising serious concerns on macroeconomic stability in many countries. Now, this is a new point which I am just introducing, which I am talking about in this MPC, because this aspect, I think, is an important aspect and it will impact the future trajectory of global financial stability and global financial system. So therefore, this point I thought I must mention here as a part of the monetary policy statement. Now, amidst the current headwinds, elevated levels of public debt is raising serious concerns on macroeconomic stability in many countries, including some of the advanced economies. Global public debt to GDP ratio is projected to reach 100% by the end of this decade. The public debt levels in advanced economies, in fact, are much higher than those in the emerging market economies. The challenges of debt sustainability in an environment of high interest rates and low growth at the global level can become new sources of stress. Reducing debt burdens is necessary to create fiscal space for new investments in priority areas, including green transition. Now, in this context, so far as India is concerned, going by the budget which has now been presented, I think government is adhering to a path of fiscal consolidation, and as per the projections made by the International Monetary Fund also, India's that is general government, the debt of both central and state governments are expected to moderate in the years to come. This is just a point of information to put things in the context. Domestic growth. Domestic economic activity remains strong. The first advance estimates placed the real gross domestic product, that is real GDP growth, at 7.3% for 2023-24, that is for the current year, making this the third successive year of growth of above 7%. Going forward, the momentum of economic activity witnessed during the current year, that is 23-24, is expected to continue in the next financial year also, that is in 24-25. Agricultural activity is holding up well despite lower inflation, lower reservoir levels and delayed sowing. Rabi sowing has surpassed last year's level as well as the normal acreage. The allied sector is also expected to provide major support to agriculture with continued momentum in horticulture and fisheries. Industrial activity is gaining steam on the back of improving performance of manufacturing. The early results of corporates in the manufacturing sector remain upbeat, driven by higher profit margins. The Purchasing Managers Index, that is PMI for manufacturing, is displaying expansion along with strengthening of future activity index. Services sector activity is expected to remain resilient on the back of strong domestic demand and stable global prospects. The PMI services increased significantly in January, that is January this year, suggesting continuing strong expansion. The buoyant demand for residential housing coupled with increased thrust on government capex is expected to propel construction activity. On the demand side, improving employment conditions and moderating inflation together with a rebound in agricultural activity should push up household consumption. Rural demand continues to gather pace. Strengthening farm level activity as reflected in declining Mahatma Gandhi Narega demand and the extension of Pradhan Mantri Garib Kalyan Anna Yojana should further support rural consumption. Urban consumption remains strong on the back of improved income levels. Investment cycle is also gaining momentum, is gaining steam, aided by sustained thrust on government capital expenditure, increased capacity utilization, rising flow of resources to the commercial sector, and policy support from schemes such as production-linked incentive. Revival in private corporate investment is also underway. Our survey suggests that investment intentions of private corporates remain upbeat and both services and manufacturing firms are optimistic about overall business conditions. Next, net external demand is also improving with narrowing merchandise trade deficit. Now, taking into account all these factors into consideration, real GDP growth for 2024-25, that is the next financial year is projected at 7%. I repeat, real GDP growth for 2024-25, that is next financial year, is projected at 7%, with Q1 at 7.2%, Q2 at 6.8%, Q3 at 7%, and Q4 at 6.9%. The risks are evenly balanced. Let me now turn to inflation. Headline inflation moderated to an average of 5.5% during April to December 2023 from 6.7% during the whole of 22-23. Food price inflation, however, continued to impart considerable volatility to the inflation trajectory. In contrast, the deflation in CPI fuel deepened and core inflation moderated to a 4-year low of 3.8% in December. The decline in core inflation continued to be broad-based, with inflation remaining steady or softening across its constituent groups and subgroups. The inflation trajectory going forward would be shaped by the outlook on food inflation, about which there is considerable uncertainty. Adverse weather events remain the primary risk, with implications for the Rabi crop. Increasing geopolitical tensions are also leading to supply chain disruptions and price volatility in key commodities, especially crude oil. On the positive side, the progress in Rabi sowing has been satisfactory and augurs well for the season. Prices of key vegetables, especially onions and tomatoes, are registering seasonal price correction. Taking into account these factors, CPI inflation, that is consumer price headline inflation, is projected at 5.4% for the current year, that is 23-24. So that is for the current year 23-24, we are projecting CPI inflation at 5.4%, with the fourth quarter, that is the current quarter, projection of 5%. Now, assuming a normal monsoon for the next year, CPI inflation for the next financial year 24-25 is projected at 4.5%. I repeat, CPI headline inflation for next financial year 24-25 is projected at 4.5%, with Q1 at 5%, Q2 at 4%, Q3 at 4.6%, and Q4 at 4.7%. The risks are evenly balanced. Now, what do these inflation and growth conditions, what do they mean for monetary policy? Let me try and answer. Inflation has seen a significant moderation from the highs of the summer of 22, that is the summer of 2022. Over the last 2 years, monetary policy has prioritized inflation over growth, undertaking calibrated increase in policy repo rate by 250 basis points and withdrawal of stimulus measures. Monetary policy was supported by proactive supply side measures by the government. That said, the job is not yet finished, and we need to be vigilant about new supply shocks that may undo the progress we have made so far. Headline inflation has remained high and has seen considerable volatility, moving in a range of 4.3% to 7.4% during the current financial year. Recurring food price shocks could interrupt the ongoing disinflation process, with risks that it could lead to de-anchoring of inflation expectations and generalization of the price pressures. Adding to these are the renewed flashpoints on the geopolitical front, including supply chain disruptions. Importantly, the CPI inflation target of 4% is yet to be reached. Monetary policy in the midst of these lingering uncertainties has to remain vigilant to ensure that we successfully navigate the last mile of disinflation. Now, the last mile of disinflation is always the most challenging, and that has to be kept in mind. Stable and low inflation at 4% will provide the necessary bedrock for sustainable economic growth. This point is very important, because if we are interested in the long-term growth of our economy, then we need a regime of low and stable inflation. That is why we remain focused on bringing the inflation, to align the inflation to the target on a durable basis. I would now like to focus on the liquidity and financial market conditions, about which there is a lot of interest in the financial markets and also elsewhere. After remaining in surplus during April-August 2023, system level liquidity turned into deficit from September after a gap of 4.5 years. Adjusted for government cash balances, potential liquidity in the banking system is still in surplus, and that may surprise you. But adjusting for government cash balance, potential liquidity in the system is still in surplus. During December-January, the Reserve Bank proactively injected liquidity through both the main and the fine-tuning repo operations to ease liquidity tightness in the system. With government spending picking up and augmenting system level liquidity, I must mention that in the recent, particularly in the second fortnight of January, government expenditure was sustained, but I think there has been a significant pickup from the second fortnight of January, and also we are witnessing the same in February. And so with government spending picking up and augmenting system level liquidity, the Reserve Bank undertook 6 fine-tuning variable rate reverse repo auctions, that is VRR auctions, during February 2 to February 7, 2024 to absorb surplus liquidity. Financial market segments have adjusted to the evolving liquidity conditions in varying degrees. While the short-term rates have fluctuated, long-term rates have remained relatively stable, reflecting better anchoring of inflation expectations as indicated in the softening of term spread in the government securities market. In the credit market, however, monetary transmission remains incomplete. Let me reiterate, and this is very important, let me reiterate that our policy stance is in terms of interest rate, which is the principal tool of monetary policy in the current framework. Our stance of withdrawal of accommodation should be seen in the context of incomplete transmission and inflation ruling above the target of 4%, and our efforts to bring it back to the target on a durable basis. So far as liquidity conditions are concerned, these are being driven by exogenous factors which are likely to correct in the foreseeable future, aided by our market operations. On our part, the Reserve Bank remains nimble and flexible in its liquidity management through two-way main and fine-tuning operations in both repo and reverse repo. So you would have noticed we have done two-way, market interventions, both repo and now reverse repo, and we have been very nimble even during one particular day, like yesterday and day before. On a single day, we conducted 2 VRR auctions on a single day. That was seen yesterday and day before, and that goes to show that we are nimble and swift in our response to the evolving liquidity conditions. Now, I would like to emphatically state here that we will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner and financial stability is maintained. The reversal of liquidity facilities under both SDF and MSF, even during weekends, which we announced in the last, that is in December policy statement, has actually facilitated better funds management by the banks. As of February 7, 2024, the Indian rupee has remained stable compared to both its emerging market peers and even a few advanced economies. In terms of coefficient of variation, the Indian rupee exhibited the lowest volatility in 2023-24 as per the data available between April to January of the current financial year. Now this I am saying compared to the corresponding period in the previous 3 years. Let me reiterate that the exchange rate of the Indian rupee is market determined. Its relative stability in the recent period, despite a stronger US dollar and elevated US Treasury yields, reflects the strength and stability of the Indian economy, its sound macroeconomic fundamentals, financial stability, and improvements in India's external position, particularly the significant moderation in current account deficit, comfortable foreign exchange reserves, and return of capital flows. Now, the confluence of all these factors put together have ensured that the Indian rupee, the exchange rate of the Indian rupee, has remained fairly stable over the last 1 year or so. I would now like to touch upon financial stability. The domestic financial system remains resilient with healthy balance sheets of banks and financial institutions. The financial parameters of non-banking financial companies, that is NBFCs, are also improving in tandem with those of the banking system. Good governance, robust risk management, sound compliance culture, and protection of customers' interest are of paramount importance for the safety and stability of the financial institutions as well as that of individual financial institutions. The Reserve Bank lays great emphasis on these aspects. We expect the regulated entities of the Reserve Bank to accord the highest priority to these functions. External sector is the next area on which I would like to touch upon. India's current account deficit declined sharply to 1% of GDP in the second quarter of 2023-24, that is second quarter of the current financial year, from 3.8% in the second quarter of the previous year. Going ahead, the net balance under services and remittances is expected to remain in large surplus, partly offsetting the trade deficit. India's services exports remained resilient in October to December this year, driven by software, business and travel services. Moreover, with around 10.2% share in world telecommunications, computer and information services exports, India is a significant player in the world software business. According to the World Bank, with an estimated $135 billion inward remittances in 2024. I repeat, the World Bank estimates the inward remittances for India to be in the order of $135 billion in 2024. Now with this, India would remain the largest recipient of remittances globally. Thus, current account deficit for both 2023-24 and 24-25 is expected to be eminently manageable. On the financing side, net foreign direct investment stood at $13.5 billion in April to November 2023 as compared with $19.8 billion a year ago. Foreign portfolio investment, that is FPI investment, witnessed a sharp turnaround during 2023-24, that is current year up to February 6, with net FPI inflows of $32.4 billion as against net outflows of $6.7 billion a year ago. Net accretions to non-resident deposits and net inflows under external commercial borrowings were also higher during the current year. As on February 2, 2024, India's foreign exchange reserves stood at $622.5 billion. Vulnerability indicators suggest greater resilience of India's external sector. We are confident of comfortably meeting all our external financing requirements. I shall now announce certain additional measures, and some of these measures are very important, so I request your patience. The first measure I wish to announce is review of the regulatory framework for electronic trading platforms. The Reserve Bank's extant regulatory framework for electronic trading platforms was issued in 2018. In view of the subsequent developments in markets, products and technology, etc., a revised regulatory framework for these electronic trading platforms will be issued for stakeholders' feedback. The next announcement relates to hedging of gold price risk in the OTC market, that is over-the-counter market in the International Financial Services Center, IFSC. In December 2022, the Reserve Bank had permitted resident entities to hedge their gold price risk in recognized exchanges in the IFSC. It has now been decided to allow resident entities to hedge the price of gold. Now let me just read it again. It has now been decided to also allow resident entities to hedge the price of gold in the OTC segment in the IFSC. This will provide more flexibility to resident entities in hedging their exposure to gold prices. The next announcement is actually very important and has far-reaching consequences. Particularly, it is something which will really benefit the small borrowers from the from the lending sector, from banks and other entities. At present, and that relates to key fact statement, that is KFS for retail and MSME loans and advances. At present, the loans and advances availed by borrowers, apart from including the rate of interest, also include other fees and charges such as the processing fees, documentation charges, etc. So as a result, what happens is that the customer, he knows that the loan carries an interest of so much percentage, but then there are other charges and fees, etc., which he pays upfront. Now that also needs to be loaded into the actual interest rate, so the customer has a clear idea that what is the actual annualized interest rate that he pays. And this is something on which as you are aware, as I have said a little earlier, customer centricity is something on which the Reserve Bank lays a great emphasis in the overall public interest. Now, to enhance transparency in disclosure of such information, that is information on various charges, fees, etc., the Reserve Bank had mandated certain categories of lenders to provide the borrower a key fact statement, that is KFS, containing essential information such as all-inclusive annual percentage rate and recovery, and also details of the recovery and grievance redress mechanism. The requirement of the key fact statement is now being extended to cover all retail and MSME loans. This measure will lead to enhanced transparency in lending and will enable customers in making informed decisions. The circular will be issued separately. Obviously, we have to give some time to the banks to comply with these requirements, because quite a few preparatory action needs to be taken at the end of the banks. The next announcement relates to enhancing the robustness of AEPS. Aadhaar enabled payment systems, that is AEPS, has played an important role in financial inclusion by enabling customers to make digital payment transactions through service providers such as business correspondents. Given their significance, it is proposed to streamline the process for onboarding of AEPS service providers and introduce some additional fraud risk management measures. This measure will further strengthen the security of the AEPS system and enhance its robustness. The next announcement relates to principle-based framework for authentication of digital payment transactions. Over the years, the Reserve Bank has proactively facilitated introduction of various mechanisms such as additional factor of authentication for securing digital payments. While no particular mechanism was specified by the Reserve Bank, SMS-based OTP, that is one-time password, has become very popular. With technological advancements, however, alternative authentication mechanisms have emerged in recent years. Therefore, to facilitate adoption of alternative authentication mechanisms for enhancing the security of digital payments, it is proposed to put in place a principle-based framework for authentication of such transactions. The next and the final announcement, the last announcement, relates to introduction of programmability and offline functionality in central bank digital currency pilot projects. The CBDC, that is Central Bank Digital Currency Retail, the CBDC retail pilot currently enables person-to-person and person-to-merchant transactions. It is now proposed to enable additional functionalities of programmability and offline capability in CBDC retail payments. Programmability will facilitate transactions for specific or targeted purposes, while offline functionality will enable these transactions in areas with poor or limited internet connectivity. I now propose to conclude. The Indian economy is making confident progress on a strong, sustained and transformative growth path. Domestic and international investors are reposing greater confidence on India's economic prospects. In our assessment, the current setting of monetary policy is moving in the right direction, with growth holding firm and inflation trending down to the target. Therefore, much has been achieved, but we must remain vigilant. Policy making during uncertain times has to be based on a continuous assessment of the incoming data and its implications for the evolving outlook. We reaffirm our commitment to bring down inflation to the target of 4% in a timely and sustainable manner. Price and financial stability are the foundations for strong, sustainable and inclusive growth. Our endeavor all along has been to take a holistic approach to keep the economy in balance. We must not only preserve the hard-earned strength and stability of the Indian economy, but also build on this further for a long haul of higher growth with price and financial stability. In the current environment, what Mahatma Gandhi said long ago remains very relevant, and I quote, "I am moving cautiously, watching myself at every step. I repeat, I am moving cautiously, watching myself at every step. But there is the fixed determination behind every act of mine." Thank you. Namaskar.
Well, hi guys there. Very good morning. That was the RBI governor there taking on and maintaining status quo for the 6th consecutive time in their monetary policy. Well, just to take you through quick highlights, repo rates, pretty much all the key rates remain unchanged. Repo rate at 6.5%. Stance is going to be continuing with that withdrawal of accommodation. In fact, if you look at the projections for GDP numbers, they've stuck with the FY25 real GDP growth projected at 7%, whereas inflation projections do unchanged at 5.4%. CPI inflation they see for FY25 at a 4.5%. They have made some quarterly changes and we'll take you through all of those details. But those are pretty much the highlights of what the governor said in his speech. This is Stacey Ferreira and joining me is my colleague Nandita Khemka. Well, Nandita, pretty much everything that is factored in. I think a non-event, one would say, after the interim budget as well. What would be your key takeaways from here, other than the few quarterly changes that they've made in inflation projections, perhaps?
Stacey, one would have thought that there would be more indication of a shift in stance. If you look at the number of members who voted in favor of withdrawal of accommodation, it's 5. Yeah. I think yesterday I was chatting with Lata Venkatesh of CNBC TV18, and she had mentioned that, perhaps we could see one or more members, in fact, 2 members vote in favor of a neutral stance, but that hasn't happened. So looks like it, it's just what my view is, the fact that, a stance change in April policy also could be a little iffy at the current juncture, if not anything to go by what the RBI commentary has come in like. But it's a cut copy paste policy compared to what we saw in December, but we'll have to go to our battery of experts and understand whether there has been a change in nuance, because a couple of things the governor pointed out, that he spoke about the debt to GDP ratio of various nations, and for us also that is a little on the higher side. So we'll have to see how really the comments we have to make sense of the kind of commentary he's given
from the finance minister as well. Of course.
That's correct. Yesterday in the Lok Sabha, right? So let's go across and without any delay and talk about how the commentary or nuances have changed in this policy, or whether it's the same language that they used in the last policy, but there has to be some bit of fine print that we could be looking at. But let me bring on board our guest. Joining me is Mayuresh Joshi, Head of Equity Research at William O'Neill India, as well as Jyoti Prakash Gadhia, MD at Resurgent India. Let me come to you, Mayuresh. Pretty much on expected lines, were you expecting a lot more in terms of a change in stance, or do you think this is what the market was expecting and the RBI governor has really stuck to it? What is your first take on the policy, really?
Morning, Nandita. Morning, Stacey. So I think the market was largely penciling in what the governor had to say. And to a large extent, there might be a few expectations in terms of the liquidity announcements. But I think the governor has also made it very, very clear that the supply-demand dynamics, as they evolve over the next few weeks and months, I think the RBI will take proactive steps in these regards. Coming back to the slight changes that have probably happened in terms of the inflationary trajectory and the expectations in terms of maintaining that stance at 4%. However, also pointing out that the core inflation is heading downwards. Rabi sowing has been extremely good so far in spite of lower reservoir levels. That really augurs well in terms of expectations of a good winter crop expected to come through, aiding and abetting further lowering in terms of food inflation. And therefore, I think as the core inflation stays lower, I think the RBI trajectory that is expected over the next few months and the expectations in terms of the 4% target hopefully largely will be met. Which brings us to the focal point in terms of the supportive mechanisms that RBI has always played out in supporting growth, to what the government is also playing out in terms of both expectations in terms of fiscal deficit going down significantly in the next financial year, and expectations of the economy still staying on a very, very strong footing. So to that extent, I think the statements that have probably come through more on expected lines. And obviously, as the global policy making also evolves over the next few weeks and months, I think RBI, as they have always been proactive, would be a step ahead as far as their global counterparts are concerned. So I think something that the market probably was expecting, and nothing negative that has probably come out of the policy.
Right. In fact, we also have Aditi Nair, the chief economist at ICRA, joining us. Good morning, Aditi. Let me straight up ask you, we have been, we've gone through all of this pretty much in the sixth time again that we are seeing an unchanged policy, and all of that already factored in. One of the points that I would like to take up or get your comments on is inflation, and how much of that is really going to change, because we are also getting into an election year. The RBI governor was very categorical in how he explained how much food inflation could have a bearing. Could that still be a reason to worry?
Good morning. See, when we look at all of the things that the governor spoke about, I think firstly what came through was a very, very strong focus on growth. And growth has been projected by the RBI at 7% for FY25, which is quite an ambitious number in our view. We have projected growth to be a fair bit lower than that at around 6.2%, because with the elections and with the budget that is likely to come in only by July, there are reasons that transient reasons that could actually result in growth being on the lower side in Q1 and Q2. With this much emphasis on growth and with this much emphasis on reiterating the areas where we need to be cautious on inflation, job well started, but, still remaining vigilant to make sure we get to 4%. Actually, even though we expected that there will be no change in the rates and the stance, I think the overall tone ended up being a lot more, I don't want to use the word hawkish, because usually I use the word hawkish when there is a lot of concern expressed on inflation being high. But with this much bullishness on growth, I think the thing that really came through to me was that rate cuts aren't going to start anytime soon. And I think there was absolutely no signal that rate cuts are going to start anytime soon. We are all projecting, or rather we are assuming a normal monsoon when we are making our projections for next year for inflation and for growth. But things could go wrong on that front. And we do end up seeing food shocks regularly, even though, the amplitude of those may be lower than what would have been there in the past. But between staples and perishables, I think cautiousness is definitely warranted. We also don't know how long the impact of the Red Sea crisis is going to last, whether that's going to have a transient impact on freight rates and any impact at all on commodity prices. In that case, we should be looking through. If it's just transient, then we should be looking through that impact. But with food inflation, I think caution is definitely the order of the day, and that's what the RBI governor expressed as well.
Right. Of course, caution is the word when it comes to food inflation, because, you never know which way it'll swing, given the fact that El Nino remains a concern. But, given the fact that, Fed has already indicated that a March rate cut is off the table for now, In that sense, given the kind of resilience we've seen in the US economy as well, when do you expect the first rate cut to come through when it comes to Fed? Because obviously RBI cannot really precede the Fed, right, when it comes to rate cuts. Do you think a Fed rate cut also gets pushed to second half of the year and not before June?
Let's assume that the Fed rate cut happens in June. If we also have an indication that the monsoon is likely to be well distributed and well timed by June, which is when the monsoon will have just kicked off, then we are penciling in a stance change from the MPC in the June policy and the first rate cut to come in the August policy. And after hearing what the governor said today, I think our view is reinforced that this rate cut cycle is going to be quite shallow, at best 50 to 75 basis points between August and December of 2024.
Right. We also have Mr. UR Bhatt, the co-founder and director at Alfinity Fintech. Thanks so much for giving us your time, Mr. Bhatt. Let me get your sense of what are you making and how soon perhaps do you see a rate cut now that we are talking about it, and perhaps the hikes have already peaked and we're pretty much going to be mirroring what the Fed does. What according to you would be that timeline then?
The policy was completely on expected lines, and I think the fact that they're still saying that next year the inflation, CPI inflation, will be somewhere around 4.5%. They've still not completed the job because they have to bring it to closer to 4% if the governor's speech is anything to go by. So therefore, I don't think that they're going to really talk in terms of reducing interest rates anytime soon. Probably sometime in June or something, or immediately after, hopefully, Fed cuts rates. That is when I think they will look at it. And that too, if there is no intermittent problems as far as inflation is concerned. I think as long as inflation is under control, closer to 4.5% or below, there might be some case for them to cut interest rates, but I don't think they're in a great hurry to do that.
Right, Jyoti, coming to you, what do you make of the RBI governor's commentary on liquidity, given the fact that he's mentioned that liquidity is still in surplus and they have conducted a series of VRRR auctions this week itself, right, in a matter of a week. Given the kind of statement that the governor has made, would you put off a change in stance in the April policy as well? Do you think that's not coming in April as well?
In this last 2-3 months, if we look at the bank term deposit rate or the saving interest rate, whatever the nationalized bank and all the larger PSU banks are, they are also not trying to increase the rate of interest and other things. Apart from the smaller banks where they might have liquidity crunch that way. And the CASA of all the banks are also remaining at a comfortable level in this last quarter. I think so, given the liquidity, there should not be any much of a problem, and given the election scenario, so whatever the government spending will also be far more higher there. So government spending is going to come, election time is there. I don't know, there will be, and the private investment is also not tickling it off to the required extent. So the demand on the liquidity side is also not much more there. So I think so, given the particular stance, maybe we can see in the month once the election is over, once the everything is streamlined, then that point of time, whatever the new government comes and whatever the Reserve Bank decides at that point of time. But till this next 2 quarters, I don't think there will be any liquidity stance change by the regulator.
Right. Let me come to Mayuresh then. Mayuresh, let's discuss or let's address the elephant in the room, Paytm. The RBI governor made a comment, compliance among other parameters is of utmost importance to RBI and financial stability. Any chance that he was alluding to Paytm and he said that? And secondly, of course, we've all seen how things have panned out for Paytm. Do you expect any kind of color, expect the governor to give any kind of color in the press conference? And, how should really one navigate Paytm at the current juncture? When I speak to technical analysts, they say that perhaps it's a trader's delight. But for investors who've gotten into the stock at IPO price of 2,000, how should one really go about this?
So I'm pretty sure, Nandita, I think a lot of media personnel will ask this question, whether the government likes it or not. So I think the government is going to be mandated to answer a few questions related to this. But having said that, I think the RBI stance when it comes to banks, the scheduled commercial banks, or the new tech or the new fintech payment banks, as we call it, under the supervisory norm, in terms of compliance requirements that the RBI probably supersedes all of them. I think all those comments will be taken in the right spirit. So to that extent, I think any of these entities should comply with compliances that RBI has probably mandated. And what further action probably happens, either from RBI or any other regulatory body in this regards, I think is going to be extremely critical when it comes to Paytm. Now, they've given their fair share of disclosures as far as stock exchange notifications are expected and concerned. But to a large extent, what really plays out over the next few weeks, specifically from a regulatory viewpoint, I think is going to be very, very critical. So I think it's a wait and watch mode, very, very frankly, for Paytm.
Right. Aditi, you did point out about how the focus was so much on growth, but could there be, what according to you could be any of these external factors that could then hinder it? And also, we are seeing quite a mixed bag when it comes to earnings growth per se. So how much will change, private investments coming in? What would be your take on how we're likely to see this growth actually accelerate? What could be those drivers?
Okay, so I lay out, my expectations for growth for FY25. As I said earlier, our view is that the growth in H1 is going to be dampened by a couple of transient factors. And our full year forecast for the GDP growth for FY25 is 6.2%. Now, firstly, the agri scenario, how much it improves is the first question mark that we have. Even if the El Nino starts receding, rural demand may pick up in a robust manner only after the monsoon season and after the Kharif earnings come in. So after the Kharif harvest, which is solidly in the second half of the year. Secondly, when we look at the model code of conduct before the elections, that is something that could lead to capex being on the slower side. So full budget, if it's presented on July 1, then typically you would expect to see spending picking up after that. But normally during the monsoon months, Government of India's capex does tend to slow down. So that means that capex again is going to be quite back-ended into H2. And it's tough to really get that much spending pushed out in a 6 to 7 month period. So, at this point, I'm not sure that the 11.1 trillion capex target is necessarily going to be very easily achievable. I am afraid there might be a bit of a miss on that. Will state government capex continue in a normal fashion during the election months? We'll have to wait and watch on that. If that is relatively normal, then there would be an upside to my forecast of 6.2%. Global growth is likely to remain tepid, and therefore exports growth is likely to be fairly subdued as well. And that is not really likely to lead to tailwind for Indian economic growth. Commodity prices still remain below last year's levels, which is giving some impetus to margins. That year-on-year gap will narrow quite significantly in the next fiscal year. So we will not get that margin boost, and volume growth will be quite important in terms of driving the overall GVA growth. And on the private capex side, our view is that private capex is happening in a non-noisy kind of fashion. We are seeing private capex in a number of sectors, but it's not, big bang. It's not very loud or noisy or exuberant the way that it would have been in previous cycles. And that is possibly the way that it's going to continue for a few more quarters. We expect realistic announcements on the private capex side, and we don't expect it to be a very, noisy kind of a capex cycle this time around. So the fact that, government capex may dip in H1 is something that will lead to growth being softer in the first half, along with the expectation that agri output and rural demand will also pick up only in the second half.
Aditi, I want to get your thoughts on where bond yields are headed from here, because if you see on the interim budget day, between surprises of lower borrowing figure and fiscal discipline, and we saw a 10 basis point fall on the bond yield. Of course, we have the bond inclusion coming up in June. So in that sense, sub 7%, do you see yield dropping below 7% a little before that, or do you think around June is where we can expect yields to come down to sub 7 levels?
See, I think the combination of three factors will be needed before we finally see yields coming below 7%. One, the bond index inclusion and the fund inflow related to that. Second, the clear commencement of rate cuts by the Fed. And third, at least a stance change being indicated by the MPC. Once all these three are in place, I think only then we are going to see yields decisively coming below 7%.
But are you satisfied with the 4.5% inflation figure for FY25, given the fact that food inflation, could of course rear its ugly head once again?
So my forecast is 4.6% right now, predicated on a normal monsoon. Typically, we do end up seeing, sort of one perishable price shock almost every year. So that would be par for the course. But yes, this is predicated on the monsoon being quite normal, which should lead to better food inflation outcomes in the second half of the year.
Well, Jyoti Prakash, let's shift focus a little bit towards the markets, because we are seeing them now come under a little bit of pressure. At least we started off on a positive note, but perhaps no surprises there from the governor, a non-event, one would say. So markets a little bit in the red right now. For an investor, rather, how should one be looking at these? Because most of these factors are already priced in. If you have to look at it, we know there's an election coming up. The interim budget was pretty much a no-show in that sense, with no big surprises. So what would be those other factors that will drive the markets then, or what are they really looking at? Because you also have the earnings. We had the last leg of earnings, which we could say were a mixed bag. So what really is going to be the push that the market needs at this point?
Let us find out. There are one or two fundamental the problem areas which the Reserve Bank governor has also pointed out. One was the rising debt which is there, and the unsecured loan portfolios. What I could hear the murmurs in all the power corridors was that all the mudra loan, which is constitute on the small ticket size loan, which constitute around 25% of the portfolio of the entire portfolio of the banks, which is the smaller ticket size loans. There is a lot of evergreening in terms of changing from working capital to term loan to working capital, changing the tenure, because lot of stringent guidelines are not being applied in terms of while rescheduling the mudra loan category. Or they might be shifting from one person to the another person. So there can be a lot of evergreening underground which is happening there. And also the debt to the ratio definitely is on a rising trend. Although Reserve Bank has come up heavily on terms of the AIF structure and other things in the recent past just to monitor this unsecured loan category. They have also increased the risk weightage also onto this unsecured loan category. This is one concern area. The second, which the fundamental good point that he has also pointed out, was that all the processing fee, documentation charges, legal fee and everything, they have to be consolidated at one, and it has to be included as a price of the cost to loan. So now any of the small time borrower or any of the borrower, they doesn't have to understand, sir, this is the rate of interest and these are the some other charges which the bank used to charge. So now there will be only one charge, there will be only one rate of interest, which will also evenly spread over the year that way. So we need to find out into the finer detail whether all the smaller banks, NBFCs and the fintech companies are also covering under these guidelines, or it is only the banks which has to follow these guidelines. So this again will be a very, very welcome step where the lot of transparency in terms of the costing for the loan will also be taken into account. Third thing, in terms of getting this NPA recognition norms, I think so Reserve Bank could have done a little bit of tweaking there, that whether the 90 days credit or the default, there is a long-standing industry demand that there has to be some differentiation between the secured credit and the unsecured credit. I think so this is a high time that in terms of secured credit, any of the bank loan where the bank will eventually realize the money which is there. There again, I think so some sort of a adjustment could have been happening there. That would have been happening. Now coming back to the market reaction, I think so the FIs and all which are there, market it is absolutely bullish. In the fundamentals are which will remain the same. It is election time. The market, there is nothing to worry about in the market. I think so in this next 2-3 days, the market will be up and ready for us to take it forward. there is no fundamental wrong in the market as on date. Thank you.
Mr. Bhatt, coming to you, what do you make of the divergent moves in PSU banks and private banks? As we speak, shares of ICICI Bank, HDFC Bank, they've all slumped quite a bit. But PSU banks, if you look at SBI, in the last 2 sessions, banking behemoth like PSU banking behemoth like SBI is up nearly 8%. Do you see this catch-up play, to private peers continue here on? And is there room for more? Is there room for more valuation re-rating for the likes of SBI and other smaller PSU banks as well?
Well, I think that is an ongoing process because PSU banks were not seen as equivalent to public sector to private sector banks in terms of their competence of underwriting risks and stuff like that. But otherwise, I think today, whether it is in terms of computerization, in terms of decision making, or in terms of underwriting skills, I think PSU banks with the completely revamped and clean balance sheets, I think they can give a run for the money of any of these private sector banks. So therefore, I think there's a gradual re-rating happening, and this fact is being recognized that PSU banks can really measure up to what the private sector banks are doing. And I think this is a gradual process that will continue as long as they are able to keep their balance sheets clean, because they've had a checkered past in terms of the ability to underwrite risk. But given that today, I think they are showing better competence in this regard, I think there need not be so much of a valuation mismatch between private and public sector banks. So that is why the public sector banks are catching up. And the private sector banks have some difficulty in raising deposits. The deposit growths are not exactly what they can actually take in order to finance the sort of projects that they have on hand. As you have seen, quite a lot of these private sector banks have problems of deposit accretion. So whereas the PSU banks generally are much better off there. So I think that is why I think the market is recognizing this fact. And that is why I think the gradual re-rating of public sector banks is work in progress now.
Right. Mayuresh, let me come to you. We've already spoken about how perhaps rate cuts will be in the second half of the year. What happens to other asset classes then? I'm talking about gold. The governor has also been trying to push and make this attractive. Residents are going to be allowed to hedge the prices of gold in the OTC segment. We are seeing the sovereign gold bond get quite a good traction. So give us your view on other asset classes. Still we see any change in terms of, rates actually being a cut or so? What happens there, and would you advise people to look at any other asset classes at this point?
So I think financial prudence does suggest, Stacey, that if you're probably having an allocation in terms of your investable corpus, a part of that has to go outside equities as well. So I think any financial planner, depending on your risk reward, will determine the weightage of how much equity and other asset classes should form part of your portfolio over a longer period of time. Having said that, and the announcements related to gold as well, the expectations of gold being a natural hedge in terms of the volatility that the equity market probably showcases, albeit from a shorter time periodicity. Obviously, I think some exposure in terms of gold, specifically looking at your tax efficiencies in which bracket you probably fall in, is mandated, and obviously on your risk reward as well. Obviously, real estate as an asset class also is something that is going through a boom cycle as we speak. So the 6-year, 7-year cycle that the real estate goes through, you're probably in the midst of this cycle. And obviously, real estate and real estate ancillaries become a huge beneficiary in aftermath of a rate cut. So if the expectation is of a rate cut at some point of time in the second half of this financial year, all the fence sitters who are probably there are expected to go in. And as supply probably increases drastically across tier 1, tier 2 cities, in fact, even tier 3, tier 4 cities as we speak, I think a large part of this real estate cycle will also get played out over the next few years. And therefore, I think having a balanced approach from a financial prudence perspective, equity is a little bit of gold, some real estate, does absolutely make sense, even from a longer periodicity of time.
You spoke about how PSU banks, they will see a gradual re-rating. But what about, PSUs, other PSUs, the likes of, power grid, NTPC, these stocks have started firing up rather. But do you think the markets are ignoring risks, when it comes to the other PSUs, and perhaps they don't really deserve the kind of valuations they command at the current juncture? What are your own thoughts on this? Mr. Bhatt, is my voice reaching you?
Oh yeah, sorry. I thought I didn't know the question was me, but I think this is something that is playing out, because general fact is that PSUs are now being managed much better than they used to be, and that is what you're seeing reflected in the pricing of all the PSU stocks, as it were. But I think quite a lot of these have had their day under the sun. I don't know whether they can really, while PSU banks are a different cup of tea because they still have reasonably good valuation comfort. Some of the others that you mentioned, they've had a fantastic run. And so therefore, I don't know whether that can continue for a long time. But I think that at current valuations, the sort of stocks that you mentioned, I think there is certainly some scope for being a bit cautious, because it cannot be a one-way street all the time. And it is not as if, especially say, for example, the PSU special purpose sort of finance companies, which are valued at dramatically higher than banks, which have access to low cost deposits. I think that is not probably something that one can see that the party can go on for long. So I think one needs to be cautious, at least in some of these PSU, non-bank PSUs, which have had a fantastic run over the last, say, few months.
But what about oil PSUs? HPCL, BPCL, all of these stocks have seen a great run. And in fact, the street is also pretty much bullish. If you look at the various brokerage notes, they are pretty much upbeat and they see more legs to that rally. Would you concur?
Well, I think the OMCs are a different cup of tea because their valuations are, quite low, and that's really a play on oil prices and the refining margins. They have a phenomenal distribution. There is no doubt on that, and I think there is certainly a lot of value resting there. But I think the press on what happens to oil prices, what happens to the tensions in the Middle East, these are things that influence these prices. But I think, as a matter of fact, I think there is a phenomenal value resting in the OMC companies, public sector OMC companies. But one can't play it for the very short term. But I think if you're a medium-term investor, I think there's a lot of value resting there.
All right, Aditi, if you're still with us, of course, it was a fiscally prudent budget, right? Government has stuck to fiscal discipline, and FY 25, 5.1% was a positive surprise. And one would say that perhaps a section of the economists may be expecting a rating upgrade by Moody's or any other rating agency for that matter. But Moody's has of course flagged off the high debt affordability of our country, right? So here on, do you expect anything to change as we head into the elections, or do you think a rating upgrade at the current juncture looks a little way off?
So I'm afraid I'm not going to be able to comment on that. Moody's is our largest shareholder, and this is not something that we need to comment on.
Sure. So, Mayuresh, if you're still with us, I want to just get in your thoughts on the consumption pack. No handouts, so to say, by the government in this interim budget, right? And of course, we've seen, volumes for some of these FMCG companies lag, right? Government has also mentioned that rural demand is picking up. However, the pace has been a little slow, right? And which is, of course, being reflected in the numbers of these FMCG giants. Here on, would you advise investors to steer clear of consumption at the current juncture and perhaps look at other sectors like affordable housing for that matter? How are you playing the themes post the interim budget now? Which are the key themes that one should look at, and which one should be an avoid if somebody is looking at rotating sectors at the current juncture?
So I think discretionary consumption as a theme should play out over a longer periodicity of time. However, from an immediate short-term perspective, the pain might probably persist. So if you look out for FMCG companies, the volume growth has been largely tepid over the last few years, and the last year was no exception as well. If you read through a lot of management commentaries, the volume growth has come at the behest of price cuts, which have probably taken place. And therefore, I think having a perfect balance in terms of strong demand coming through, getting reflected in volumes, and then appropriately reflected in price creates huge positive operating leverage for these companies. I think one of these legs is definitely missing, where demand is obviously on the lower side. And input cost, though they have moderated, the expectations of rural discretionary demand and spending expected to come back can only happen after the monsoons. So I think if the monsoons are better and on track and a normal distribution as expected for the next financial year, the second half is where I think a lot of these aspects will start playing out. Till that point of time, I think valuations are sky high for most FMCG companies as we speak. And therefore, our take is valuations on the higher side, they've made late stage basis as far as market space is concerned. And therefore, we will wait and watch as the stock goes through a consolidation phase. Having said that, I think the domestic cyclical themes is something that one must pursue over the medium to longer term time frame as well. Yes, I think over the next quarter, as we get into election mode, a lot of the ordering activity is going to get stalled. But as the numbers and as the election results are probably out, ordering will start in the first half of the next financial year. And as substantial ordering picks up as we head into the next financial year, and as we've seen as historical track record in terms of the execution that most of these domestic cyclicals have probably done, I think they should be relatively better placed off. So domestic capex-oriented companies, as a proxy to that, I think housing, where the government has probably laid focus, some aspects of real estate where the cycle is still in the midst of that 6-7 year cycle as I spoke, some real estate ancillary stocks as well, cement as a sub-theme which is expected to continue doing well, and a few of the consumption-related stock, not directly FMCG, a few of the packaged food companies as an example, can still keep on delivering well, because I think urban and semi-urban consumption will still hold out. And as rural consumption comes back in the second half, I think that creates an amplified effect as far as numbers are concerned for second half of FY25.
That's the thought then, Mayuresh. If you look at the markets at the current juncture, I mean, they've seen a sharp fall. In fact, the Nifty is down nearly 180 points as we speak, and the Sensex is off 1,000 points from its day's high. Of course, the culprit Nifty Bank Index, if you look at some of the private sector banking names, Axis Bank, Kotak Bank, ICICI Bank, all of these names are under pressure. In fact, 2.5% kind of cut coming in on Axis Bank, ICICI Bank down 2%. Contrasting moves when it comes to some of the PSUs. SBI, as I mentioned, remains among the top gainers. 4% uptick coming in there. Other PSUs are gaining. Power Grid, BPCL. These are some of the companies or stocks that are holding the fort. TCS, HCL Tech, some buying coming in after yesterday's profit booking in technology names as well. But the texture of the market has completely changed, barring the mid-cap index, which is just about managing to hold on in the green. Look at how the Nifty has fallen. Mayuresh, your thoughts? What could have triggered such a sharp fall all of a sudden?
So the move also had been very linear, Nandita. So to that extent, I think the markets were looking for an excuse to probably have some element of profit booking coming through. I think the markets, I don't believe that the markets was going in very optimistically in terms of some statements related to rate cuts that the governor will probably give. But largely, I think the policy has no negative surprises. So I think the market probably is booking profits as we speak. We are at elevated levels when it comes to the main index, the broader markets as well. A lot of stocks in the broader markets, Nandita, have moved 3x, 5x times of where their price was almost a year back. So I think an excuse that the markets is probably looking at this juncture. And I think as we draw close to the end of the day, I think we will come back to the fact that nothing has structurally changed for the markets. And it will be as normal as it is when we head into markets tomorrow. So I think a normal day of profit booking and an excuse that the markets are probably looking at.
So pretty much hoping that we see this turn by the end of day, the sudden drop that we are seeing, at least markets reacting to these no-show, we would say, from the RBI governor at least. But also let's get Lata Venkatesh from CNBC TV 18 is also joining us. Thanks so much, ma'am, for your patience. Your quick takeaways pretty much all laid out for us. They're quite straight. But what would be that one standout point for you from this, from the governor's speech this time around?
Well, 2 or 3 standout points, I would say. If we were expecting that there will be some indication of softness, it was not very clear. He did say that, you have to mix these two statements, that we will use a bunch of instruments to regulate both frictional and durable liquidity. Basically, it means I can use repo, I can sell bonds, buy bonds and give liquidity. I can use many instruments to regulate liquidity. And my stance has not changed, but that is because my stance is looking at inflation. Don't confuse it with liquidity. So it is possible that the Reserve Bank in the coming weeks will give a little more liquidity to the market, and therefore deposit rates won't rise. We don't necessarily have to see this policy as negative. But the fact that he didn't explicitly say that he is going to change the stance or even hint a change of stance later on, I think has disappointed the market for the moment. But I would still not think that this is a hawkish policy by any standards. In my book, there is still a lot of evenness and maybe a bit of dovishness also, because he has brought down his inflation forecast. Both the inflation forecast for the current quarter, it was originally 5.2, he has made it 5. And for the fourth quarter next year, in fact for the full of next year, the inflation forecast is 4.5. Now that emphatically means you are on the path to 4%. So, there is a very good chance that sometime later in this year, mid-year, there could be a stance change and then a rate cut. So by no means is this a hawkish policy, but we will get more details in the press conference. The positive which the market should take away is the Reserve Bank putting it on the table and saying that this is a 7% economy next year. The government has not said it. When TV Somanathan, the finance secretary, spoke to CNBC TV 18, he said, I won't bet on 7, I bet on 6 something. That is my basis for this budget. So the governor is being even more bullish than the government, which is a very rare instance. Normally central bankers are more conservative. So I would take that as optimistic for the market. And then of course there are some small crumbs thrown for MSME companies. On the whole, I don't think there's anything in this for the stock market to be disappointed. If they thought that he will change the stance, that was simply running ahead of themselves. We can still see whether we will smell a cut. Going by the inflation forecast, I think it's a slightly dovish tone.
Right, Lata ma'am, Nandita also joining in. Yesterday we were talking about how, it could be, time to go and book your fixed deposits. If the government gives, the RBI gives an indication that, the best of deposit rates are behind us. But, the governor has also maintained that rate transmission is still underway. So do you think we are yet to see the best of deposit rates?
That is a very good guess. That's precisely why I'm still waiting for the press conference to check out, since he said he is not happy with the transmission of the 250 basis rate hike. The RBI itself is smelling some more increases in loan rates. So maybe that is what is disappointing the market, that he's actually saying that there should be more transmission of hikes. He's not talking about the current levels as the highest level for the market. So an inching up of both deposit and loan rates cannot be ruled out. That's absolutely well put, and maybe that's what's troubling the market.
So ma'am, going into the press conference, would you expect the governor to give any kind of comments or color on the Paytm issue? Would you be asking him questions on that?
We are going to ask him a volley of questions on that bank. Now it's for the governor to either duck and say we don't discuss specific companies, or maybe give something. But to be sure, he's going to be asked.
Right, so we'll wait and watch to see what comes out of that press conference as well. We will be streaming that live for you all there. But thank you so much, Lata Venkatesh from CNBC TV 18, for giving us that perspective. And also to our guests who've joined us, Mr. Jyoti Prakash Gadia from Research in India, as well as UR Bhatt from Alphinity FinTech. Thanks so much, gentlemen, for giving us your time. From Nandita and me, well, this was, pretty much factored in RBI policy, where the governor has gone on to maintain status quo, repo rate being at 6.5%. For all those updates and the governor's press conference, keep tuning in to moneycontrol.com.
Thanks a lot for watching.